Neil, come.
If everybody can just mute yourself, that would be great. I don't know how to do that. Thank you. Okay, let's see. What time is it now? 8:01. One more minute. Mindy, can you mute yourself? Thank you.
I just did it for her.
Oh, good. Thanks. Okay. Let's get started. It's 8:01. Good evening, everyone. It's so nice to be on Zoom again, and 2024, the first session. My name is Lou, if you never met me before. I'm a financial professional specialized in family financial planning. My most passion is helping families with college financial planning, and then also the long-term care. So tonight we're very excited. It's a new topic, and I want to just let Pam, my partner, introduce herself here.
Hello, good evening, everyone. First, I want to thank you for all of you taking the time to join us tonight. My name is Pam Chow, and I'm also a financial professional. My specialty is in retirement planning and strategy. I work for different employee benefit consulting firm, insurance company, and I'm happy to have this opportunity to share some of our experience with you tonight. So stay tuned, and Luke, back to you.
Yeah, thank you so much. And we both love to share our knowledge and experience. And most of our clients, of course, are parents, and most of my clients are parents. And oftentimes they will want to help their children to build the wealth and to do financial planning. And they're also frustrated or concerned because their children seems not interested in any financial related topics. So they said, Lou, if you and Pam can do a topic in English and just, have a conversation with them and give them some basic knowledge. And we say, why not? And financial knowledge should be for everybody. And something that we shared with you tonight is something we felt we should knew when we were in our 20s, 30s, or even 40s. I mean, we didn't know much, right? So super excited. And we have East Coast clients. So it's quite late right now. We will keep our session within 45 minutes. So hopefully we finish at 8:45. And we will record this and put it on YouTube, share the link with you so you can review it again. So oftentimes people ask, what is the wealth formula? Do you have a formula to build the wealth? Kind of, but it's really hard to have a set formula, but I put something together here. Hopefully it helps you to understand the whole wealth process, right? So the wealth always begins with money. If you don't have money, you can't build from nothing. So money is always the fundamental starting point. And then after money, there is time involved. Why is time so important? Because the earlier you start, the better it is to build the wealth. We will explain that later. And then it comes to the rate of return. There is positive return. There are times you will get negative return. So how to navigate to maximizing your return and to do a better risk management, it's also important. And then there is inflation. Inflation is something that you can't control because it just comes, right? And it's not something that you can master. Tax is definitely something we can do. So we will be spending quite some time tonight talk about money, time, and the tax. And along the way, of course, you have to be healthy to be wealthy. Right? Health is very important. And we're not going to talk too much about that, but it's definitely part of the formula. If we're going to talk about finance, we have to talk about compound interest. Why is compound interest so important? Because it's the most powerful force in finance. Compound interest is so powerful that most financial planner always put this as a top priority, whether your return is a compound interest or simple interest. So what does compound interest really mean? Compound interest means you earn your interest on your principal. In addition, you also earn interest on the interest you earn. Kind of complicated, but I will explain. So rule of 72 is another thing that you often will hear that. And if you never heard that before, now you hear it. Rule of 72 basically is using number 72 divided by the interest rate. And that is the years you need to double your money. So I give you a very simple example here in the table below. Let's say that you start at age 29 and you put down $10,000 to invest. If the return of interest is 2%, use 72 divided by 2%. That will take 36 years for your money to double. So by the age 65, you will have 20,000 in total assets. If the interest return is 4% compound interest, that will take 18 years, which means at age 65, same amount of money that you put in at age 29, you will get 40,000 in return. 8% takes 9 years. Very same. It all starts at 29, age 29. The investment amount is $10,000, but at age 65, because the return is 8%, you will accumulate $160,000 in wealth. Now, 12% is a very good return, right? And if you happen to get that, that means every 6 years, you will get your money doubled. At age 65, same amount of investment. At age 29, you will accumulate $640,000 in wealth. So this is the rule of 72, and this is the powerful compound interest. And I hope that you remember this rule of 72. It's very easy. Now, the cost of waiting. We often hope that, I'm a mother of 2 young adults, and we often hope that our children will learn to save money and will learn to save money early, right? And we're always trying to explain to them, it's so important to save early, but we never can technically explaining to them how so. So this is exactly how so, the cost of waiting. Let's say that you're age 25. You start saving $10,000 a year. You save for 10 years, right? 10,000, 10 years, compound interest rate at 8%. By age 34, you stop. You don't save anymore. That you save only 10 years. So you invested $100,000, you saved, you invested. At rate of 8% return, let's see, at the end, at age 54, which is 30 years, this will accumulate to $729,000 in your total assets. That's 8% compound interest. Okay, here's your friend who waited 10 years. In the first 10 years, 25 to 34, he or she didn't save any. And then she or he started at age 35, which is 10 years later. Same amount of saving, $10,000 a year. Save 20 years, which brings the principal to $200,000, right? $200,000 at age 54, same age. When you check your investment portfolio, guess what happens? One that saved $200,000 will only accumulate $494,000. Why the first one, where you saved 10 years earlier than your friend, will have so much in return. Now, this is the cost of waiting, and many people don't know. And they only know that you need to start early, but they don't really know the fundamental math behind it. So starting early allows you to leverage compound interest for maximum benefit. The power of time allows even small contributions to accumulate significantly. It is so important. And you often hear, like on social media, sometimes people were saying, we want to start saving early as the baby, like start saving. That's why you need to start early. Maybe the day that you're born, if you can start your children, the day that they were born, you have no idea what that means, right? So my message to the young adults are save now, save early. Don't wait. Save now. Okay, I'm going to turn the microphone to Pam, and she is the expert on retirement. I'm going to let her talk about the powerful retirement saving tools. Pam.
Okay, thank you. Now Lou had demonstrated the power of saving early, saving as soon as possible. So today I'm going to start talking about, now we know why, so I want to talk about how. So how do we save? What tools are available out there for us to use so that we can save our investment, our contribution? So for retirement, I gather 4 different options. These are the popular ones that we see on the market. So the first one is 401k or 403b. These are the employer-sponsored retirement plan. The contribution that you put into the plan is pre-tax, meaning that you don't pay taxes now, you pay tax later. The second one is the traditional IRA. Traditional IRA is self-sponsored. You can open up an account with the bank, with the brokerage account. You can administer your own account. The contribution is also pre-tax. There's another one, it's called Roth IRA. Roth IRA is also self-sponsored. However, the contribution is after tax, meaning that you pay the income tax for the year that you contributed, but then when you take out in the future, everything is tax-free. So that's Roth IRA. So the first 3 retirement plans are closely monitored and ruled by the IRS. So there's a limit on the contribution, and there's a limit on the age and the deductibility. So for 2023, for 401k is 22,500, Roth and traditional IRA is 6,500. Right now we're in a tax season, so we're all preparing our 2023 tax return. If you haven't filed your tax return for 2023, and you have you have IRA or Roth IRA, you still have a chance to contribute to your Roth IRA or IRA contribution if you haven't filed your tax return, okay? So that's a message for you. The fourth one is annuity. Annuity is a great tool to save for retirement. It has more flexibility and more choices to option you can choose from. So I'm going to talk about each one of them in the following slides. We can look into it more in details. So this one, the first one is a mighty 401k. If you work for an employer and the employer sponsor a 401k, you can sign up and become a participant. How it works is you set aside part of your paycheck and then you contribute that to your 401k. So that part of the paycheck will be excluded from your income. So you don't pay income tax for that year, you pay it later. So you lower your taxes for that year. Oftentimes, the employer plan, this 401k, comes with an employer match. How does an employer match works? I'll give you a simple example. Maybe you'll see a formula. You need to understand how your plan works if you're a participant. A simple example is like the employer may say, for every $1 you put into your plan, I'm going to match 50 cents, maybe up to 6% of your pay. If that is your formula, I encourage you to max it, to contribute up to 6%, to max out your employer match, because that's a free money. As long as you put in your money, the employer matches that. So don't leave it on the table. I have employees sometimes tell me they toward the end of the year, they look at their year-end bonus. They're so disappointed because the bonus is so little. They work hard for a whole year and that's all they get. There's not much I can do with help them with their bonuses. But then look at the employer match. have you max out your employer match. That's a free money there. That's something you can do on your own. So don't leave it on the table. So that's one advice I have for you. As far as the investment option in the 401k plan, oftentimes you will see lots of investment options. For example, you may have money market fund, you may have a fixed income fund, you may have target date funds, you may have mid cap, small cap, large cap, lots of options for you to choose from. So I want you to choose wisely based on your risk tolerance and your goals. And monitor your fund performance once in a while. Some people throw money in there and don't look at it anymore, okay? So you need to monitor that at least twice a year. Look at your statements. If the funds are not performing to what you had expected, you can switch them. It's free to switch them. There's no capital gain consequences. Monitor that, okay? Like I said, the 401k is tax deferred. So your principal, your interest, everything is tax deferred. You don't pay taxes until you take it out, until you retire. If you take the money out before you age 59 and a half, there will be 10% extra taxes, the penalty tax. So wait until you're 59 and a half. The last one is fine-tune your paycheck withholding. Why is that? A lot of people are happy to get a tax refund after they file tax return. But I want you to, monitor your tax refund every year. Are you really making less money, or are you having more for the year that result in your tax refund? If those are not the case, chances are you have too much money withheld from your paycheck. So if that's the case, you can lower your withholding, modify your withholding, free up those money and put that in your 401k, maximize your employer match. If you pay too much ahead of time to the IRS, they're not going to pay you too much interest for your advance payment. So look at your withholding, figure out if you have extra money there, you can move it to the 401k. That's my advice to you, okay? The next one is we're going to look at traditional IRA. Traditional IRA works similar to 401k. The contribution is also pre-tax, and you can, manage your own account. It is also tax deferred, principal and interest. However, there is the income limit that might apply to the deductibility of your traditional IRA contributions. For example, year 2023, if you are an active participant in your 401k and your modified adjusted gross income is over 73,000, that's assuming you're a single filer, okay? If your modified gross income is over 73,000, the deductibility starts to phase out, meaning that you may not be able to deduct or will contribute to the full amount, to the 6,500. You might have to reduce that, okay? But if your modified adjusted gross income reaches over 83,000, you are not going to be able to deduct any of them. So before you contribute to your traditional IRA, make sure you double check the requirement and eligibility, okay? If you are not eligible and you contributed, there might be a penalty. The next one, I'm going to talk about Roth IRA. Roth IRA works a little differently. The contribution that you put in, you have to pay income tax for the same year. However, the principal and the interest in the plan that will grow tax-free, and when you take it out after you retire, all the distributions are tax-free, okay? Same thing with this one. Income limit applies for eligibility. For the plan year 2023, if your modified adjusted gross income is over 138,000, you may be limiting to your contribution. But if your modified gross income is over 153,000, you're not able to you'll not be able to put in your Roth contribution. So make sure you double check your eligibility before you open an account, before you put the money in. Okay, so that's the Roth contribution, the Roth IRA account. Any Roth account, any traditional IRA account, you have a lot of options. If you open up an account with the brokerage, they offer so many different funds as well. Same thing. You want to choose a fund carefully, based on your own risk tolerance and your goals. So be careful. That's an investment option you want to look at. The fourth one is the annuity. Like I said, it's a great tool for investment and also for retirement. My favorite one, there's so many different annuities out there. My favorite one, the one that I'm going to focus on today, is the fixed index annuity. Why? Because number one, the fixed index annuity provides the downside protection and upside potential. What does it mean? It means that once you put your money in, if the market goes down, okay. So if the market goes up, you have interest earned, so your value will go up. If the market goes down, your balance will remain the same. It's not going to go down as the market goes down. The next year, if the market goes up again, then you have more interest to earn and your value goes goes up. So it's like a stair. You either stay the same or you go up. And then you either stay the same or you go up. It will never go down because the market has a negative return. So that's one of the things I like about this type of annuity. It protects your principal, protects the earning that you earned in the past. And when the market is going up, you have the potential to grow. So that's one of the features that I like about this annuity. With index annuity, it has a choice of index selection. Their selection you may see is like Bloomberg index, PIMCO index, Dow Jones, or NASDAQ. You can choose a different index to invest. But then I want to remind you that your money, your investment, is not actually in the index fund. It's actually sitting in the bond fund. The index performance is just a reference number. They take the rate of return as a reference. They calculate the interest for you and credit you that interest to your bond fund. And that's why when the market goes down, they can still guarantee your principal and your interest that you earned in the past. So that's another reason I like about this annuity. And the third feature is if you select that, it guarantees your lifetime income. It's sort of like Social Security. Yeah, the longer we live, the more Social Security that we get. If you live up to age 90 to 100, more than 100, as long as we're healthy, we're living, we continue to receive those payments. You never have to worry about you running out of money. So that's the beauty of annuity. It's a lifetime income. Never have to worry about you're gonna stop the income. Same thing as tax defer, but depending on what type of money you invest in an annuity, it could be tax-free as well. So it's up to you. Annuity comes with a lot of options. You can choose to take a lump sum distribution, and you can choose a lifetime income. You can customize it, based on your needs, based on what you're looking for. Annuity is a great tool also for estate planning. Estate planning means that we want to preserve our wealth and our assets that we build throughout our lifetime. And we want to leave that as a legacy to our beneficiary. So annuity is a great way because they preserve our principal, preserve our potential, preserve our balance. So it's a great tool that we can leave that as a legacy to our beneficiary. Another great tool is permanent life insurance. Permanent life insurance provides a great benefit for estate planning. However, not everyone will be qualified for life insurance because of their health conditions. If that's the case, those people are not qualified for life insurance. Annuity will be a great option for them. Because annuity, when we apply for annuity, we don't ask for a medical condition. We don't ask for a blood test. We don't ask that. So annuity becomes a great tool for estate planning as well. So the next slide I want to talk about, let me see. Okay, great. So the next slide I want to talk about is the historical income tax rate in the U.S. Why do we want to look at the income tax rates? Because earlier the slide Lou had mentioned, for the investment formula, we have to look at the taxes. It has a very close relationship with a rate of our return. So like Lou had mentioned, we thought we paid too much income tax, but look at this chart. On the left-hand side, there's a number from 0 all the way up to 90. That's the income tax rate. Down below is from year 1920 all the way to year 2020. Relatively, you can see that from 1920 to 1990, the tax rate is actually a lot higher than what we're paying right now. You could see that the highest one can be even more than 90%. You know, you see 80%, 70%, even 50, 40%. For this year, 2023, our highest tax bracket is only 37%. And it's been this way since 1990. So it's been this low rate for the last 30 years. And my question for all of you is, how long can we maintain this low income tax rate? Well, some experts are saying that because of our budget deficit, we continue to raise the ceiling. The chances are in the future, our tax rate is going to be higher. We don't know what the future will hold, but as we build our portfolio, my suggestion is we want to build a well-rounded portfolio, a balanced portfolio. So we want to think about, do you prefer to pay income tax now, or do you prefer to pay income tax later? Think about that while you build your portfolio. I think a golden rule is to diversify your portfolio. If you have an investment portfolio, take the time to evaluate them. How much of your investment will require you to pay the income tax later in the year when you retire? And how much of your portfolio will give you free income tax, will give you free, no tax rate, free income tax distribution? And are you prepared for the result of your portfolio? Any tax implementation will impact your rate of return. So usually a well-rounded portfolio, a diversified portfolio is what we prefer and what we recommend. So this is the end of my slide. I think Lou will continue with the portfolio. How do we balance our assets and things like that? So Lou, back to you.
Yeah. Thank you so much, Pam. I often look at this chart and I kind of tell myself, stop complaining, Lou, because I always complain how high the tax is, you know? But when I look at this graph and I'm like, no, I need to stop complaining. We're actually in the low right, 2023, 2022. So our tax rate is actually relatively low historically. So just be very thankful. Tax is something that we all should gain knowledge on. It's so important if you are working or you are doing your own business because you will get taxed. So I summarize 3 different buckets for tax. All your assets will fall under one of those buckets. So let's take a look at the left-hand side. It's taxable or tax always, or tax every day, whatever it is. It's tax often, you know? So with savings and CDs, we often use our after-tax money to put in the bank. We earn very minimum interest rate. And those interest rate at the end of the year, you will get a 1099 and you will need to pay tax on. So stock and mutual fund is your investment portfolio. Anytime when you do tradings or when you put the money in the investment portfolio, somebody else is doing trading for you, you will require to pay the tax on the gains. There is short-term gain, long-term gain. So it's tax always. And the rental income is another thing. We're not going to touch too much about it. But you do need to pay rental income. There is ways that you can reduce the tax, but you do require to pay that. Tax deferred, I think Pam spent a lot of time talk about that tax deferred category. And tax deferred means you don't pay tax now, but you will need to pay tax when you take out the money on your retirement, for instance, if it's a retirement portfolio. So the tricky question is, you do not know what the tax rate will be. Let's say you're 30 years old. You're going to retire in 35 years. You don't know what the tax rate will be in 35 years. This is an unknown. What if the tax rate doubles what's current tax rate? Then you are in loss, right? You are in significant loss. And your wealth will be somewhat damaged in a way, right? So that tax deferred is not absolutely the best because it's only not paying the tax now, but you will eventually pay the tax, just don't know the rate. So that's what all the tax defer is. And we see a lot of people maximizing their 401k and the 403b, and they not qualify to put IRA. If you don't have business, you cannot do SEP IRA. And annuity is probably one of the good ones because it doesn't have the requirement. You can put as much as you want. You know, if you get a bonus, you can put into annuity, but also you need to take into consideration the tax deferred component to that. A lot of my clients from Northern California earning the highest income right now. And I see a lot of time their financial portfolio, when I do the planning for them, they max out their 401k and the 403b, 401k mostly, max out that, and then they have their stock option, which is tax always, right? And then they have their tax deferred. So all their asset portfolio is on tax deferred and tax always, and millions of dollars. And when I explained this to them, they're shocking. And they thought they are saving tax, but I said, not 100%. We don't know yet, right? So be very sensitive to tax deferred. Now, I must bring out the tax-free component, the bucket, because that is the most ideal world. You don't pay tax. That's why everybody is talking about Roth IRA. You see so much on social media. People are talking about putting money in Roth IRA. But Roth IRA has a limit. You cannot put as much as you want. And it's only maximum 2024 is $7,000. $7,000 whole year, that's not going to build you wealth. That's not enough, right? So what tax-free means is not like you don't pay tax completely. It only means you pay some tax now, but you never pay tax on your gains and your distributions. So you pay tax, you pay your tax due, and then you invest. Anything that you do, it will be tax-free. So it's still the best scenario compared to this 3 bucket, right? Roth IRA, I just briefly talked about it, and Pam explained it. 529 plan, it's very limited. It's for education fund only. And a lot of time when I do the college financial planning, I might not recommend that because it's so restricted. It's so limited. Tax-free bond, you can tell because it's so flat. There is no good rate of return here. It's just very low rate of return. So the last but not the least, the most powerful, mighty, tax-free investment tool that's out there is 7702 IUL. Sometimes people call that cash value life insurance and index universal life. You can call whatever. 7702 is the tax code, and it gives the estimate or the indication of what's the maximum fund you can invest in this type of product. So in summary, I just want to let everybody remember this tax table and to think where your assets currently at. You can do a kind of an estimate, right? Where your assets at. Is that in tax always or tax deferred or tax free? oftentimes, 90% of time, my clients always tell me, Lou, I don't have anything for tax-free because I don't qualify to get Roth IRA. I never save for 529 plan. I don't have anything, so I'm not taking tax advantage. I said, too bad. You need to start now. So this is advice is don't put all the eggs in one basket, right? It's simple. And also to keep in mind, I think it's very important. It's good balance is always important. We're not saying this is wrong, this is good, this is bad. We're just saying that you need to have balanced asset portfolio. And depend on your age, it does shift. That balance could shift. When you're 20, 30, or when you're 50, 60, it's a very different asset portfolio you should own. But it's good to keep this in mind and to always have in mind what's tax-free, how tax-free is important to your asset, your wealth building, right? Okay, so I'm going to touch very briefly about Index Universal Life, and I have not many minutes left, so I'm going to go really quick. So Index Universal Life, it's a tax-free investment tool, and it is a life insurance. So it has the traditional life insurance component to it, which is the protection. So life insurance, fundamental benefit is protection. You will get tax-free death benefit, bypass the probate. Your beneficiary can get the tax-free death benefit without any question. That's life insurance component to it. Adding to it now, it's living benefit. It's no longer, the life insurance is no longer after you die, you enjoy the benefit. You can enjoy that when you are living. So the living benefit often includes, it could be different product, have different living benefit, long-term care, chronic illness, critical illness, and terminal illness. So we're not going to spend a lot of time talk about the protection, but focusing on the saving part, because that's the investment opportunity, tax-free investment opportunity. Interest, it's based on the market index. So you have a downside protection, just like the index annuity, same thing. So your cash value is preserved and it has no loss to it because it's a downside protection, 0% protection. Liquidity, if you ever need the money, you borrow from any institute or financial services, there will be interest involved, right? And over here, you can borrow from yourself. You can take money from your cash value. It's like a little saving bank. You can borrow that. And tax advantage, it's tax-free accumulation and it's tax-free distribution. So no tax at all. But last but not the least, it's so important. Your life insurance asset, it's private. All your other asset, your retirement asset, your bank asset, your investment portfolio asset is a public information. So there is no protection there, but life insurance does. So talk about liquidity really quickly. The product that we often design for clients, there is a different stage of life that you might need the money that you don't know when, right? Oftentimes we explain to clients, it's like the first phase is probably when you're graduating from college, you start working for a couple of years and you're thinking about start your own business. You need a startup fund and you can just, take from your cash value savings from a life insurance. That's no tax, no interest. You can just borrow or take. The second phase is like if you get married, you want to buy a house, you need a down payment for your house. Where do the money come from? Over here. The third time is after you have children or child, and he or she might need a college fund, and you can take from there. Let's say that you never touch this money. This money will stay there for a long time. You can use it as a retirement, tax-free retirement income. So there is a lot of way to get this saving tools activated when you have this product. There is a very good book to read on this tax-free universal life insurance. It is called The Financial Pocket Knife, and it's by James Stoddard. So you can get this book from Amazon. It's a very good read for explaining everything. Here's an example of my client actually got this product for her child at age 31. And it's a very, I just literally just choose one of the simple explanation ones. And the rate of return on this one is 6.7%. By the way, average IUL rate of return is about 7 to 9% historically. So that means it's since the product is introduced, like historically, it's about 7 to 9%. So this one, let's do a hypothetical. $8,000, this is actually a illustration based on 6.7%. So $8,000 per year to invest, to put in this IUL, and death benefit is $500,000 for 10 years. So you put in the premium, it's about $80,000, right? And cash value accumulation in the beginning, because the cost of insurance is a bit high, so you might not see, but at year 10, you should see the breakthrough, like you can see the break even. You start seeing the cash value growth. And let's say that you never touch the money. You decide at age 65, you want to start your lifetime retirement income. Okay, so that time your $80,000 premium has already generated, based on 6.7 average return, $428,674 cash value. So based on that, the calculation says you can take out $38,480 per year as a tax-free retirement income for life. So let's say at age 70, $80,000, your premium, your investment, you already collected $230,888 in retirement income. Plus, you still have $477,000 in death benefit if anything happens to you then. You continue to live your life, right? Simple. I mean, we all live long life. The next generation, even longer, they are saying maybe over 100. So at age 90, same 80,000 that you initially invested or you put in as a premium at age 31, now you have already accumulated $1 million in retirement income, and you still have $318,000 in death benefit. If you would have never take any retirement income, your accumulated cash value from this policy with 6.7% rate of return could generate cash value of 2.3 million, close to. So that's the power of IUL. And this is something that not a lot of people know about, and only the richest are using it, build their wealth and do the estate planning. So I'm just spending very brief time to help you to just show you an example of this product. And I know you have questions. Maybe you might think, oh my goodness, you know, this is so complicated. It's a lot of information. Don't worry. Pam and I are both independent agents, which means we can sell any financial services or insurance company's product in the US. And we are not limited what we can choose for our clients. Our passion is to help our clients to do customized financial planning, to build their wealth, to do a good asset allocations. So this is our email. Feel free to reach out to us, and we provide the free consultation for the first time, initial consultation. And we also started a Wealth and a Wellness Academy on the YouTube, and we have topics like long-term care, annuity, college fund, and all that from last year. So feel free to follow us and to like us. And also feel free to share tonight's presentation if you really like it. I think time-wise, I'm so good. Pam, you have 1 minute just to say some final words.
Yes, like I said, building a financial strategy is complicated, but you have to start somewhere. NBC News just broadcast that they find a study, the younger generation nowadays is making a lot more money than we did when we were young. But however, they're not saving nearly enough or as same as what we did before. So this message, hopefully that will, change your mind. start saving early. You see the impact with Lou's illustration. Any questions, building your portfolio, whatever age, we're here to help. So here's our email. Feel free to send us an email with your question. We'd love to help you. Thank you.
Thank you so much, and a good evening, and a thank you. And I think we kept the time perfectly. Thank you so much. Thank you.
Bye.
Bye-bye.